Now, you've been following along, especially if you caught last week's video. You probably already know that the US and China trade war just hit a whole new level of trade disputes. So, last week we talked about China's export restrictions on rare earths and Trump's jaw dropping 100% tariffs announcement. But if you missed that one, the short version is that we're looking at a full blown economic face off between the two biggest players in today's global economy. So, this isn't theoretical, it's not just posturing, it's actually happening. So now let's talk about what's coming next, because the real consequences haven't even fully hit yet. And more importantly, let's get into what this means for your money, for your business, your career, and your financial plan. The thing is that we are in a new phase of economic warfare. What we're seeing now is no longer just a trade dispute, but something that is shaping up to be a long term decoupling of two intertwined economies, one that's been decades in the making. China is tightening its grip on strategic resources like rare earths and battery technology, and the US is hitting back with tariffs and export controls on AI chips, semiconductors, and software. The way that both are moving right now is not just a tit for tat anymore, it's systemic. So we're watching the unraveling of global supply chains that have defined the last 30 years of economic growth, which doesn't happen overnight, but as it's unfolding, there's going to be winners and there's going to be losers. So the question becomes, how do we make sure that we are on the right side of that? So let me tell you first about the immediate impact. Let's say inflation, shortages, and uncertainty. Because you've probably noticed that inflation has cooled off a bit over the past year. But this kind of geopolitical tension is like throwing gasoline on a fire that was just starting to go out. And 100% tariffs on Chinese goods, remember that doesn't just hurt Chinese companies. That actually makes it so they raise costs here, especially for industries that rely on Chinese parts, components, and raw materials. Electronics, appliances, electric vehicles, solar panels, all of these things will get more expensive to build, and you guessed it, they don't just eat the cost. Businesses will pass on those costs to the consumers. So if you've been holding off on buying a new phone, a laptop, or even a car, it might actually be a good time to reconsider it. Or it might not. Whatever works for your budget. But these prices, there's a possibility that they might not be going down anytime soon. And on the business side, companies that rely on China for manufacturing or materials, these guys, they're already scrambling. Most likely they're going to pass on the cost to the customers. Some of them might eat and take the margin hit, but smaller businesses, a lot of them might not be able to stomach and weather this tariff war, and they'll go out of business. But what does this actually all mean for you personally in terms of your personal finance? So here's actually 5 key areas where this trade war is going to touch your life, even if you've never bought a stock in your life. So number 1, like we mentioned, consumer prices will most likely climb up because higher tariffs equal higher import costs equal higher prices. That's basically economics 101. And if you're in the market for consumer technology, home goods, or even certain groceries and supplements, which a lot of them come from China, you might have to expect to pay more for these items. But what should you do then? Well, if you are considering any essential or must have big ticket items, it might be a thought to either get them sooner rather than later. You can also consider looking at domestically made alternatives, especially for recurring purchases. And then also adjust your monthly budget to factor in rising costs, especially heading into the holiday season. Number 2 is that investments could get volatile. We saw the markets drop hard after the tariff announcements last week. And that's likely just the beginning of technology, manufacturing, auto, and retail sectors. And that's likely just the beginning. Because for technology, manufacturing, the auto industry, and the retail sectors, they are all exposed to this conflict. So, what to do about this? You should already be doing this, but if you're not, then go ahead and review your portfolio. If you are heavily exposed to companies that are dependent on Chinese manufacturing, you should probably consider diversifying. I think it makes sense to keep more cash reserves because you don't want to get caught needing to sell investments during a downturn. You should also look for upside opportunities like companies that are building alternate supply chains or domestic rare earth mining operations. Number 3 is you have to think about your career and how your job security could be affected. If you work in a globally exposed industry that includes many manufacturing ones, logistics, technology, or even agriculture, this trade war might actually ripple into your paycheck. There's going to be less demand, tighter margins, and shrinking export markets, which can all lead to hiring freezes or layoffs. So, what do you do about this? I've mentioned this in my previous videos, but it is always a good idea to keep on upskilling and personal development. So boost your value in your current role or position yourself for a pivot. You can also start building a side income. Remember, it's never too late, and the best time to start is actually now. Even so, start doing this even if it's small at first. You should also strengthen your emergency fund. Aim for 3 to 6 months of expenses at the least. Or if you are financially savvy enough, then customize just the right amount that you think will be enough to cushion you for any emergencies. Number 4 is that small businesses are going to be in the crosshairs. So if you're a business owner and you run a business that imports goods or depends on the Chinese supply chains, the time to act is yesterday. So margins are about to get crushed unless you have a plan. And what do you want to do about this is number 1, you want to audit your supply chain, start looking for alternative sources, maybe not all domestic, but definitely more diversified. You could raise prices strategically and communicate clearly with customers about why this is necessary. You can also cut non-essential costs now so that you aren't scrambling later. Number 5 is that real estate and credit markets, they could shift. So if inflation ticks up because of these tariffs, the Fed might be forced to hold rates higher for longer or even raise them again, which is going to affect mortgages, car loans, credit card interest, and business credit. So in this case, you might want to consider locking in any major financing soon. For example, if you're shopping for a home or a car, you might want to pay down high interest debt while rates are still relatively stable, and consider avoid taking on unnecessary debt right now, especially variable rate debt. Now, with all that being said, I want to make sure that you guys understand the bigger picture, which is that decoupling is not just something unique. It's a trend, and it's an increasingly growing trend. One thing to emphasize here is that it's not really just Trump's policy or a Chinese or China reaction. No matter who's in office next year, economic decoupling is basically just going to become the norm. And US companies, they're already shifting production to countries like Vietnam, to Mexico, to India. And remember that the Biden administration, they even pushed friendshoring and domestic manufacturing. So now Trump is taking a more aggressive tone, but the strategy is basically going to happen whether it's Republicans or Democrats. And the message is clear that there's going to be less dependency on China and more domestic control, which creates friction, but it also creates opportunity. Now, how should you stay ahead of the curve? So again, just let me leave you with a few personal finance action steps to help you stay not just safe, but ahead in this environment. So number 1 is make sure to keep following global headlines, but you have to read between the lines because countries usually participate in a lot of positive or negative framing depending on whether it's a friendly country or a rival country. So look for what's not being said. Think about this example. When China restricts rare earths, what industries indirectly get hit? You could also invest in long-term trends and not short-term noise. So materials, energy storage, domestic infrastructure, automation, these things aren't just buzzwords. They're actually where capital is flowing. You should keep your financial plan flexible. In a volatile world, rigid plans will break and snap. They're fragile, but be ready to shift, adapt, and pivot. And then you could also build more financial resilience, which means emergency savings, multiple income streams, and possessing and developing skills that hold value across industries, because all these things will help keep you safe, keep you stress-free. And when you have more resources, more capabilities, more ways to make money, you keep open a lot more options, and that way you aren't just backed into a corner. So with all that being said, the bottom line is that the US-China standoff, it's not just political drama, it is an economic earthquake, and the aftershocks, they're going to be felt in every portfolio, every business, and every household. So my last words for this video, stay informed, stay nimble, and remember that we cannot control the global economy, but we can control how we respond to it.